The stock market might sound complicated, but it's actually a simple idea once you break it down. It's a place where people buy and sell pieces of companies, called shares or stocks. When you buy a share, you're becoming a small owner of that company. If the company grows and makes a profit, your share's value usually goes up, and you can either sell it for a higher price or receive part of the profit through dividends. In simple terms, the stock market works like a big online marketplace, just like Amazon, but instead of products, it's full of companies. Every time you hear that the stock market went up or down, it means the average value of many company shares has changed. The main stock markets in the world are places like the London Stock Exchange, the New York Stock Exchange, and NASDAQ. In the UK, big companies such as Barclays, Tesco, and BP are listed on the FTSE 100, which represents the top 100 largest firms on the London Stock Exchange. Investors, whether they're individuals or big institutions, buy and sell these shares based on how they think the company will perform in the future. For example, if you believe a technology company is going to release a popular new product, you might buy its stock expecting its price to rise. The stock market runs on supply and demand. When more people want to buy a share, the price goes up. When more people want to sell, the price goes down. That's why prices move all the time, sometimes even second by second. To help keep things organized and fair, companies must meet strict rules before joining the stock market, sharing their financial reports regularly so investors can make informed decisions. The main reason companies list their shares on the stock market is to raise money. Instead of borrowing from banks, they sell a portion of their ownership to investors. This process is called an initial public offering, or IPO. The money raised from an IPO is used to grow the business, develop new products, or expand into new markets. For investors, the goal is to buy shares when prices are low and sell them when prices rise, earning a profit. But the stock market isn't just about quick trades. Many people invest for the long term, letting their money grow steadily over years through the power of compounding. Over time, history shows that stock markets tend to rise in value, even though they may fall in the short term due to events like recessions or global crises. For instance, after market drops such as the 2008 financial crisis, many markets recovered and reached new highs in later years. That's why experts often advise patience and diversification, meaning don't put all your money into one company or industry. Instead, spread your investments across different sectors to reduce risk. Some people prefer to invest in funds or ETFs, exchange-traded funds, which are collections of many stocks managed together, offering built-in diversification with lower effort. AI-powered trading tools and apps have also made investing easier than ever, allowing everyday people to buy shares, track performance, and even get automatic recommendations on their phones. But while technology helps, it's still important to understand the basics. Stocks can go up and down, and no system can predict the market perfectly. The key is to invest with a clear goal, a calm mindset, and a long-term plan. In essence, the stock market reflects people's confidence in the economy. When investors believe companies will grow, they buy more, pushing prices up. When fear spreads, they sell, driving prices down. It's a constant cycle of optimism and caution that keeps the global economy